Do we really need another video on the silver crash of Friday the 30th of January 2026? Well, it's you to decide. I watched a lot of AI generated videos over the weekend, so I can promise you this is not AI generated, and I might share some insights over my 30 years of experience as a market maker and investor in the industry, what might have happened on last Friday. Stay with me. Welcome, fellow traders, investors, and speculators. I was looking forward to make this video. Obviously, we want to talk about the silver crash that happened on Friday. Intraday down minus 38% from the peak to the trough. On closing basis, 30% down. And you hear everybody talking, oh, that shouldn't have happened. That's a Six Sigma move, and it shouldn't have happened in 1,000 years. Yeah, it shouldn't. First of all, the 1,000 years number is wrong. If it is a Six Sigma event, it shouldn't have happened in 2 million years. Six Sigma based on a volatility of 100. That's the implied volatility we had the day before or on the day. So that is already questionable. Are we taking 100% implied volatility, or are we focusing on the 25 on average over the last 15 years we had in historical volatility? So what's the Sigma move then? It's about 24. How likely is something like that happens within 24 standard deviations? That is, I've asked Grok, the lifetime of the universe, 13.8 billion years, multiplied by a trillion, and you say the word trillion 9 times more. 10 is too much according to Grok. 9 is a little bit too little, so it shouldn't have happened. Yeah. So what number are we taking? Are we taking the implied volatility? Then we have dot on a Six Sigma move. Shouldn't have happened within the last 2 million years. Or are we going for 24 standard deviations priced on historical? Then it's actually no. So, but the bell curve, yeah, the calculation is based on, is for the random distribution of returns. So let me ask you the question. Riddle me this. Was that a random move we saw on Friday? No, of course not. Yeah? The random distribution works over a long run with equities. Eugene Fama got a Nobel Prize for that to prove it. And then we have the fat tails. If I've ever seen a fat tail, that was one. Just like oil trading negative, or the 87 crash in the stock market, which went down 27-28% intraday. Not as much as silver, but hey, still there. So we've seen a very strange situation where the market was clearly not following a random distribution. So what was it following? Obviously, there was something going on. Yeah? And the question I'm asking myself, what was going on there? And hear me out. I had an idea. Somebody was saving the financial markets on this Friday. How do you mean that? We've heard all about the debasement trade for 1.5 years now. If you follow my program and my conversations I had with Nick on the Grey Market Talk, that was a topic. So if silver went through the ceiling, gold went through the ceiling, people would look at the dollar and say, is that really still the currency which should be the world reserve currency where stuff is priced on? It would show the dollar weakness. So I thought, who's the benefit from this whole thing? And the Romans created the phrase, qui bono, who's the benefit? And I thought, okay, I have a little toolkit available. I've traded options for the last 30 years. Let's just look at the options expiration on SLV contracts on the 30th, on Friday, and let's have a look on the day before what happened in this market. And that was actually quite interesting. I'm going to put the slides in here while I'm talking. So on the day before, on the 29th, we had roughly 360,000 open interest contracts. And of these roughly 360,000 contracts, 217,000 were in the money, which means stand to be exercised on the SLV, and 141,000 were out of the money. Okay, so what happens there? If all these contracts end up in the money, I'm exercising my call option. Somebody would have to deliver the SLV to me. All right. The next day, situation changed a little bit. Open interest was basically unchanged. However, now we only had 33,000 or 34,000 contracts in the money, and 340,000 call options were suddenly out of the money. So from an open interest when the price was at 105 of 61% in the money and 39% out of the money, we suddenly switched over to only 9% in the money and 91% out of the money on Friday evening closing. Why is that interesting? Well, let's have a look. What happens if I exercise a call option on SLV? First of all, I'm long the call, somebody else sold it. The one who sold it has two options. He can sell it naked, which means he doesn't have any SLV to deliver, or he sold it covered. He sits on a portfolio of SLV and sells his call options so he can deliver. Let's assume now for a moment that he can't deliver. What does that mean? The market would get squeezed to an infinite amount. What would that do for the dollar, for the whole trust in financial markets, in fiat currencies? Not a good sign. So in a situation like this, you would assume, okay, fine, we have the ultimate squeeze. But that actually is not true, because there's a difference between the SLV and, let's say, for example, Bitcoin. There are never more than 21 million Bitcoins. You can't create more. You can create more SLVs. That process works actually quite nicely. Let's say you're a big bank in London. You take a bunch of silver coins, of ounces of silver, ship it over to BlackRock. BlackRock, who runs the SLV fund as an administrator, creates new SLV shares and can produce infinite amount of SLV shares as long as somebody else delivers silver in there. And that's where it gets tricky. If nobody increases the supply in SLV, boom, we're going north. Okay, for everybody who's short, not a good sign. For the dollar, not a good sign. If you're creating a lot of SLVs, you need physical silver. Yeah? The number I'm showing you now is actually, if we take the Thursday evening, we would have to cover all these short calls with newly created SLV shares. 19 million ounces of gold. The next day, it was down to 3 million ounces of silver. Yeah? So we went from 61% in the money to 9% in the money. And there are calculations. I've asked Grok again how much silver was actually in the vaults in London, which was not spoken for, which means lent out or already part of a silver trust. And there's a wide variety from very low, only 100 million ounces were in there, or up to 300 million ounces. Well, let's have a look at this. If it's 20 million ounces, that would drain 10% if we have 200 million out there on one expiration contract, the January. So what is going to happen in a market like this if the physical silver is in high demand? A bloodbath. So somebody must have thought, okay, what is worse? Making a few speculators happy and crashing the whole financial system, or making some people who speculated on the long side very unhappy, but we saved the world? Let's exaggerate. So I think the option was, let's save the world. Let's suppress the market for silver and gold. So how are you going to do that? Obviously, you have to have somebody who has really deep pockets. Let's say a balance sheet like a fortress. Then you have to have somebody who is very able, worldwide connected, and has very clever boys and girls there who are actually doing the transactions. Okay? You need that. Then you need somebody who's also very versed in the techniques of spoofing a market, manipulating a market. Maybe you find somebody who has already been prosecuted and fined for that. Obviously, I can't come up with any name who would qualify for that. I also don't want to be libeled or sued, but you make up your own mind. Who would fit this role? And then we can have the idea what happened on Friday afternoon. Somebody dumped a lot of silver into the market, paper silver. Market panicked. The exchanges increased the margins at the same time. So the shaky hands and the retailers and everybody who couldn't follow the margin requirements got squeezed out. And then, I don't know who did that, but you can Google it yourself. At 75, somebody seemed to put in a large buy order. What has happened? The market, I think, was saved. Yeah, somebody did show, okay, we are the big boys in the market, and you can't do a second Bed Bath and Beyond or GameStonk or anything with us. We are showing how things work. So, as bad as it is for the individual speculator who thinks, yes, silver has a future, and silver could go far higher, and the debasement of the US dollar is a real thing. People don't trust any more in the dollar valuation, especially for the future. They print more and more and more. On this day, I think the market was saved. My personal congratulations to whoever orchestrated that, who did that. And if I'm a total conspiracy nut, who thinks that's rubbish, then let's all just wait for the Commodities Futures and Trading Commissions, the CFTC, the equivalent of the SEC on the equity side, for their comprehensive report how something like that happened. You could read that on the 1987 crash, you could read it on GameStop, on everything that was going on, so I'm fairly confident we will see this investigation, nice 15, 20-page paper, in the next 10, 20 days. And if we don't see that, somebody was not interested in finding out what really happened. So, I hope you followed my nice little tour de force. Conspiracy theories galore in there, maybe not, but there was a clear mechanic for the option side. I did demonstrate that on one pesky expiration date, 30th of January, the SLV. Not even talking about the futures options, OTCs in the market. That would have already drained the market for physical by something between 5 and 15 or 20% in physical on this one day. Please tell me in the comments what you think happened or whether I'm going here completely overboard. I hope you enjoyed that and see you soon. Bye-bye.